Hi, everybody. Welcome to episode 145 of Shunya One. We have an amazing conversation up ahead for you. We speak to Ashish Dave. He's the CEO of Mirae Asset Venture Investments out of India. And on this episode, we talk about a whole bunch of different things. We talk about the challenges of working with Mirae, which is a traditional finance company, mostly in the mutual fund space. We talk about what are the kind of opportunities that Ashish is interested in India. What are the places that he is looking at to make investments, and how COVID has affected the overall ecosystem.
Hey Ashish, welcome to the show. How are you doing?
Good, man. Just, it's a comfortable Saturday. We finally managed to speak to you and Amit. Thank you for having me here.
No, not
No,
at all. We're
no,
glad to be doing this.
we are fine. Happy to finally also talk to you. I know I've seen and heard of you a lot more before we actually got to know each other. I think you have been pretty popular amongst a lot of the startup and VC community over the last few years, definitely more so for all of your very prolific deals. But we're going to get into a few of those interesting ones, which I know everyone would love to hear about. But, to give a little sense of how you specifically yourself and of course what your company Mirae is doing in the startup landscape in India. Could you give us a little background on how you guys got started? You guys are the group is a traditional financial services company. It's not your, as you were sharing earlier, it's not a typical VC, but obviously you guys are doing deals like in fact one of the most I would say ambitious venture capitalists around, which is great for the ecosystem. So what's the backstory, Ashish, personally for you, and also how your fund came to be?
Yeah. So I think I joined Mirae Asset after, when I was at Kalari, the small stories, I think some of the Mirae Asset folks had come to Kalari and I had presented to them, gave them an overview about India, what India venture ecosystem is. I think somewhere they, found me there. And I think, a couple of months later, the recruiter reached out to me and said, there is an opportunity over there. And I spoke to my partners at Kalari and I said, hey, this seems very interesting because you have to set up a venture practice from scratch. This was not one of the fly-by-night operators, and that's the reason I jumped at it, because they have been in India. They were in India for last, 12 years, right?
Mm-hmm.
They started in 2007, and they've been in India, boots on ground. They're fairly, committed to India. And I said, why not work with them? It's a large South Korean financial services group with assets over $450 billion across securities, insurance, real estate, asset management. And I said, why not work with them? And I think the first year we spent in, what are the sectors to go for, strategy to go for. We raised a fund, it's $1 billion fund that we raised called Mirae Asset Naver Asia Growth Fund, with Naver as an LP. And Naver is like, the Google of South Korea, probably, one of the largest tech giant in Korea, South Korea. And we worked with them to sort of raise that fund. We have certain other pools of capital as well, with them, with GSC, a couple of other strategic LPs. And we started, deploying into the Indian market. And I think if all goes well, in just last 2 years, we would have deployed $350 million in India, deployed to committed in India. And we started with a growth strategy where we will invest into late stage companies because we still feel there is a lot of value in those companies, and come to mid growth. What we found out last year is that, hey, because of our funds, sometimes there are certain opportunities you cannot get into those opportunities early on, because fund restricts, right? Your minimum check size has to be $10 million or $5 million. And I said, if you want to get into some opportunities early on, how can you get into those select opportunities? And that's why we created a small fund called Mirae Asset Venture Opportunities Fund, which is an India-focused fund, to deploy out of that pocket into some of the Indian companies early on. So we now have ability to write checks from $500K to $50 million, and if need be, we can write larger checks also, because our balance sheet is strong enough for us to write those large checks, which could be some of the PE deals, $100 to $200 million deals. And then we have the public market practice. For public market, we manage around $15 billion worth of capital for our Indian retail investors. We also manage some offshore funds. And Mirae funds are among the top performing funds So it's said that if advisor recommends three funds, one of the fund is Mirae fund. That's purely from the public market performance. So net, what we want to do is be present in the early stage to mid stage to growth to pre-IPO, and then follow through the performance in the public markets as well.
Is there a specific kind of area that you all are investing in primarily, or is it anything that seems like a great opportunity?
So I think to start with, our focus has been consumer internet. We went into Big Basket, Ola, we went into Shadowfax, Zolo Stays, and now we are focusing more on fintech because financial services is something we feel we're very long on. I think I say this often, that if the last decade, it created a lot of returns for people who invested in e-commerce. I think the next decade is for startup opportunities in fintech and SaaS. So our focus is going to be SaaS, fintech, and of course, consumer internet remains a focus of area. We will look at other opportunities and other sectors opportunistically. We are expanding the team as we speak. So, it's a function of how we can expand the team and, cover all these companies. So we are focused on, but all tech enabled. We may not look at, very non-tech businesses. Opportunistically, we may look at it if it fits into the Mirae asset from a strategic standpoint, but otherwise from a venture standpoint, pure financial investment perspective, mostly tech and tech enabled.
Interesting. And so you've been in the VC space. You've seen obviously, the India story a little early on as well. And now now obviously we are in the thick of it. It would seem again, actually, we are in the thick of it. I thought 2015 was when, the first sort of explosion of funding for Indian companies happened. And now it's happened. It seems to not end anymore. I think the floodgates have opened and, funding is just there. You guys are obviously a very large, like you just explained, like a large backed group. You are specifically going into very strategic. You're playing at various levels, right? As a fund or as a source of capital. What for you personally is now the most interesting space to play in? Is it like coming from a Kalari, which was again early stage, right? It was early to mid stage sort of funding. Now you're doing all of these, like you said, so many check sizes. Where is the action the most interesting, and where is it the most harrowing? I want both sides because it's also getting VCs are no longer. I hear a lot that the struggle is real with even VCs now, not just with startups.
Yeah, struggle is totally real, right? I think I often say, getting into a company is almost like getting into Virar local at Dadar station. It's very hard to get into an allocation, right? Right? How do you have to really, it's hard. It's a good problem to have. I think, but see what happens is if you look at the ecosystem, there is a lot of action at early stage and seed stage. So there are so many founders, there's so much of liquidity. There is a lot of action over there. Over there also, to get into some good deals, allocation is very, very hard. And once you get into those deals, there are other investors who are like, hey, I missed out. Why don't I basically give 2x of the price, get into this company? Because it still looks cheaper because they're betting on something in future, right? Which is what is happening over there. So the madness to get into those deals is very different. That, hey, I'm, investing in something, this is going to be a little, interesting play, good team. I want to get into this one, right? So that's moving the market in the early stage side, right? While on the growth stage side, it's a little different. There aren't too many assets available, but there are certain number of funds, global funds who have come, who are now, doubling down on those. So, when you put money in those companies, right, suddenly all of them, are flushed with capital. And because as I said, that market is still not very deep, it's shallow, right? There's a different kind of allocation issue over there. Here, there are too many startups, but the good deals, people want to get into. Over there also, there aren't too many startups, but all the good deals, people want to get into those ones, right? So there is a different kind of allocation fight at both levels. And why is this happening? I think this is purely happening is because of COVID. What has happened is people have realized that, the India tech re-rating is here to stay. So if I would say the last year mean was here, right? Post-COVID, the cycle has gone up, right? The peak, okay? it will flatten out or it will plateau and will come to a new mean. There will be some mean reversion happen, but the new mean is always going to be above than the old mean, right? So net people are seeing that, this is here to stay. Uh, I don't think, there will be some pullbacks, but I don't think, people are betting here. It's not a trading, right? This is investing, which is long-term FDI investing for 5 to 10 years, right? So money comes here and stays here. It's not something that you can take it out easily. So it's far more long-term, and the impact that we'll see with what is happening is going to be here for quite some time. So net, I think, COVID made sure that, now the India market is not just the top 50 to 100 million people, right? The next 200, 300 million people are also digitally, they are fairly, I would say they are okay with digital adoption. They're okay to use it. So I don't need to tell them that buy this app. I don't need to, advertise them that why this is convenient for you, why this is important for you, right? They've seen it. Demon also helped it in some sense. So all of these matters, or all of these things have made it, India tech is a very attractive market for a lot of these people. And I always feel that, where do you create venture returns, right? Venture returns look for what? Just basic things. A large market with a consumption-driven economy, young demographics. So if you look at all the global funds, they will have a US or a global fund. They will have a China fund, and they'll have an India fund. Because these are the geographies which really make, which are attractive, or which are probably have all the necessary elements for you to create venture returns and large tech venture companies, right? So I think this is here to stay. And of course, with whatever we're seeing in, some other countries, where, there are some regulatory crackdowns because of which, capital will pause over there, the capital will flow here. And also the capital available today is cheap. So with all these factors, I think some of this is here to stay for some time. I don't think that, we will have 18, 20-hour long days for even founders, also for VCs also.
I want to kind of, if I could, this is very early in your answer, you mentioned this, right? Where you were saying that the number of companies either in the early stages or even in the growth stages are fewer, or the opportunities are fewer, right? And I know that this might not be your particular but why do you think that it's shallow like that, right? Why do you think the depth of market is shallow? And what's needed to kind of make it a more broad-based as an ecosystem, right? I mean, like what helps increase those opportunities?
So I would say it is shallow on the growth side. It is not shallow on the early stage. Early stage, I think you have, I think everybody becoming an entrepreneur, everybody trying to, have a startup or whatever, all that will happen, right? I'm saying on the growth side, the market is shallow because all these
apps,
the
scaled companies.
So all these companies took 2 to 3 years, 4 years before they were, to grow into this particular thing. And as you grow, right, there are going to be some companies which are not strong companies, which are weaker companies, they'll fall off, and only the strong ones will survive. So your pool, when you look at growth companies, is probably, 100, right? As compared to at early stage, like, at Kalari or at Mumbai Angels, I think we would look at 1,000 to 2,000, 1,500 plans every month. That is not the case at growth, right? At growth, the funnel is narrow.
Right? But even when you were talking early stage, right, one of the things you mentioned is that a lot of people are trying to get into the same deals, right? So that means that there clearly is, like, this kind of some which are really attractive, some which are not so attractive, right? And so what is it that kind of would help? Because again, a lot of our listeners are people who are entrepreneurs or trying to kind of raise, right? So what's the difference between those two, the ones which you think, okay, yeah, this is the one that everybody wants to get into, and these are the ones which are not? Because again, I get the idea matters, team matters, all that matters, but besides that, is there something you see as differentiating?
No,
what causes the VC FOMO in that?
So the VC FOMO is purely because there's a guy who's ex PNG or ex HUL or ex Hotstar or Flipkart. He's leaving, and everybody's chasing them. Now you don't have the entire engineering team of Flipkart leaving and starting something, right? You have very select these people who have been in the ecosystem, or probably who have proven their work, right? They are trying to do something of that sort. Or probably there are some people who, some of the batchmates from the VC or the startup ecosystem, they've said, we've seen these people work. They work really hard. I think these are the people we want to bet on, right? So those are the deals where, there is a lot of, I would say, hey, we've heard too many great things about this guy. We've heard too many great things about this lady. She's done really well. Let's go and, put money. And probably the idea or the space that they're cracking also is very attractive. So that's the reason why there is. So it's not just the team; it's also the space plus team. So I always talk about it's not product market fit; it's more about product market founder fit. That is very important. So those things drive. So it's more about, and at the same time, with so much of liquidity in the market, right? Everybody's sitting on liquidity, right? People are cashing out on ESOPs, they're getting rewarded, engineers are making, crazy salaries. Everybody has some money. People, another thing that has changed is your FD investment doesn't make sense anymore. The young India wants to take some risk and said, I'm okay to sort of let this go. Whether it goes zero, happens zero, it doesn't matter, right? But my opportunity, the upside is high. My downside is going to be my capital, but my upside is very high. So they're very okay. So there's new pool of capital from the angel side, from the family offices side, etc., that is coming here, which is why we have enough. Which is like people are like, hey, why I should take some more money, extra money. So the seed rounds, if you see, right, statistically, if you just look at the numbers, the earlier seed round would be, probably, $500,000. I think now a seed round is 4 mil or 2 mil easily.
Yeah.
Right. Even early stage investors or, growth stage investors like us, we've created vehicles. There are other people who created vehicles. And early stage firms are also going very early on, right? There's a joke in the industry that we're just, it's time we will start seeing embryonic deals, right? Right, where people start betting on something of those kind of things. But, so people are going on here because, the allocation issue will happen throughout the value chain, right? So you better get into some of the deals which probably look interesting, attractive early on, right? So these are some factors that come to my mind.
Oh, I mean, embryonic deals is a interesting new catchphrase, but that's I'm sure it'll happen. I'm sure there is someone tapping into, I don't know, the VCs probably use tools yourself, right? You look at you use data, you use some sort of mechanism to find those right kind of deals. Maybe embryonic deals are the ones where you're literally looking at who are the people in other companies who have potential to start up. Like some machine learning is telling you that this guy, I don't know, his Twitter feed looks like he's unhappy at his job and he's going to start up. Do you have tools like that too?
No, I don't have tools like that, but you do get to know that there are some people who are just on their way out and they probably start up somewhere, and they start building relationships with you, so you stay in touch with them, and whenever they have the team in place, etc., or the idea in place, people go for it. So that's something that happens.
Wow. So
I think there is a model in US also, right? That I think one particular SaaS investor, he sits out of probably anybody who leaves Salesforce or one of the large SaaS companies, the VP, senior VP or whatever he has left. Okay, we'll take him. We'll create a small product. Then there are investors who are backing him. So that will happen. In fact, that will happen, right? That's a natural way in which how an ecosystem grows, right?
Yeah, that was also part of my earlier question, right? This VC, today we are sort of joking about it as VC FOMO. You mentioned liquidity. You obviously we understand India as a market is there's so much potential to unlock, but the road from this current chaos to a very mature ecosystem like there it is in the US, right? What is the road to that? Because right now it looks like it's like a gold rush, right? Whereas in the US it's not. Well, it's always a gold rush in some sort of in some new fad, but otherwise it's a very homogeneous sort of mature VC ecosystem. Is that something you see happening in India soon, or is it like what needs to happen? What needs to happen for it to get there?
So a couple of thoughts here. So number one, will it happen? Definitely it'll happen. With India, you can always say it'll happen. The only thing any investor can't say when it'll happen, right? The right question is whether it'll happen. And I think, broadly, all people over here, we can say that it'll happen. Whether it'll happen 5 years, 10 years, too hard to say. Whether it'll happen in 5 years, maybe not. It'll happen in 10 years, you'll be far more confident. It'll happen in 15 years, definitely it can happen.
But what is that form? What is the ingredient missing?
Yeah, so the missing ingredient is like, the most important thing for our startups to be profitable, more sustainable, be large, GDP per capita, that number has to really, really improve, That number is not. And I will pick up this thing that Abhay Pandey from A91, he had mentioned this a specific thing which makes which makes a lot of sense. In US, what happened is consumerism was there and technology came later.
Mm-hmm.
In China, consumerism and technology came right at the same time. Okay. In India, technology has come first and consumerism, which is GDP per capita, is something that is going to follow. So if that happens, right, we are really sitting on a, and that's what most of the investors are betting on, right? That's what they're saying, that, once this GDP per capita, everybody will, the profitability question will basically be addressed. And the other point too also it is, see, people invest, they value their time and convenience, and they're okay to pay for it. I don't think we as Indians have valued our time and convenience. A mass India has not done that, but we are seeing that. So if you ask me this question that, when Swiggy and Zomato, they were launched, will people pay 30 rupees for delivery? The answer was like, maybe not, very small portion, right? But today it is normal. You will easily pay for a delivery. You don't want to go to a bank. Sorry. You don't want to go to a bank. You don't want to stand a queue because you value your time. You value convenience. You do not want to, you have money, but you don't want to buy a car because, getting a driver or finding a parking slot is inconvenient, right? Yeah. It's not about the money part. We always say that, Indians ke paas paisa nahi, Indians actually have a lot of assets and they have money. They need to just figure out, their financial management. They need to be a little bit more risk taking, instead of, a lot of money lying in gold and, real estate, and, fixed deposit needs to flow into the equity market, capital market, right? That all has to happen. That change will happen over a period of time. But people have started valuing their time and are okay to pay for time and convenience, right? That is what most of the startups are trying to solve. And when you try to solve for that, profitability and that pool of Indians is increasing. And with the new young, Indian, the demographic that we are talking about, which is actually a burden, last 20 years back, if we saw, today that is paying dividend, right? So for that piece, I think profitability is in sight. So, so we will see large companies established, but it will take some time. I don't think it will happen overnight. It will not happen overnight. It took probably, 12 to 13 years for us to have a Zomato kind of IPO, right? So of course we are not very early investors in Zomato, but we are very late stage pre-IPO kind of investors in them. But the journey itself is why it's a very important milestone is, it creates a playbook for a lot of other folks to come and say, okay, this is how you take the company IPO. Your public market also starts evaluating that, okay, this is how we have to look at tech companies. They also understand, and Indian public markets, if you ask me, right, from a public market perspective, when we were at, how will you create alpha, right? You can only create alpha by, getting into some new growth opportunities.
Sorry, what do you mean by alpha in this context?
Alpha is basically any generate that, excess return that you generate on the benchmark.
Okay.
So if I say Nifty 50 is my benchmark, whatever return it generates, any excess that I generate on that, right, is what alpha is, right? How will I generate more return? See, the best way to do it is you put in Nifty 50, but I'm supposed to beat the benchmark and generate excess return, right? So excess return, how will you generate, right? By getting into some, you can't create alpha when all mutual funds are investing in the same kind of companies. You have to invest into some new age kind of companies, right? And when these companies get listed, there are two more things that, one, they can become larger and the growth investors get exit and that money flows back into the ecosystem. Right. Secondly, when they become very large, right, then, coming to the same point, they can do large M&As, right? Now, we had Flipkart M&A, right? So a $20 billion kind of M&A happens when there is a $200, $300 billion kind of company. Right. Yes. For you to have really pull off large M&As, $1 billion kind of M&As, we need to have large unicorn companies or decacorn kind of companies, listed tech companies, which whose equity will be valuable and you can do the swap and you can buy these companies, right? So that can only happen in capital market. So it's almost like, the companies, it's almost like the fish is leaving the pond now. The pond is it cannot outgrow the pond. It has to go to the sea. Sea is where, it can get as large as possible, right? Which is what I would say the capital markets function is. So, our markets will get deep. Our markets will get broad. It's just a matter of time. And in investing, we always say you can never time the market, right? You just have to go long. And, the companies that are basically created should be created with a view that, can these companies be there for 30 to 40 years, right? Because that's where, institutional investors, patient investors, that capital will come and stay in that company.
Given what you explained earlier, like where there's like a gold rush at obviously the early stage, there's so much FDI and other funds which are just throwing large sums of money even at the super large growth stage. Do founders, what is the founder DNA today, in your opinion? I mean, when you obviously evaluate, you mentioned you look at their background, they're hardworking and etc. But given founders are sort of spoiled for choice at all levels, do you think the psyche is are you promoting the right psyche of building quick long-term companies, or are you saying get valuation, multiply, get more money?
So you will have all kinds of people. You will have people who are going to basically be focused about building large companies like Sanjeev Bikhchandani. He's there, I will build a large company, stay in that company. That is what my bread and butter is. That you will have those you will have certain people who are just there for the quick buck. You will have that. It's almost like, you have, pickpocketers in India. You don't have pickpocketers in West. No, you have it equally spread all across the world, right? So the same thing, you will have good founders. You will have those kind of founders. It's very hard to differentiate who you're picking in, because you will only discover that after you invest and you see them over a period of time. You see them over a delta. When they come and walk into in a meeting with us, founders are always putting their best foot forward. Is that the best time to judge? No, probably no. What do we look at is, does the founder has an institution mindset or no? And when you have an institution mindset and not promoter-led mindset, what are the things that I'm focusing on? Does he have the ability to build a team and say, boss, I am creating this thing. See, how do you create legacy? You create legacy by creating institutions. So you die, but the institution won't die. But the institution will always have that, hey, this particular person created us, right? That's how you create legacy. So you can immortalize yourself by just doing that. Our founders thinking from that perspective. Our founders are thinking, no, I want to be the fastest unicorn. I want to be this. I want to be that. If people are thinking that way, you do get an idea that, okay, they are just thinking short term. They're just thinking of, flipping the company for. Is it right or wrong? I don't think there is a right answer for that also, because there's nothing wrong in, creating some company, selling and flipping it, becoming a serial entrepreneur, because if that's your art, fine. There's nothing wrong.
Also, many people say, right, there's a difference between the art of building a company and managing a company, right?
Yeah.
So, I mean, like in many cases, founders do kind of are designed to move on.
Yeah, they're designed to move on. So that's totally okay, right? So you do, as an investor, you figure out, where you are. Now, for us, it's important for us to basically, be into those companies long on, because we feel, these companies, when they go public, there is a lot of value to be created, right? So that's how we look at it. If these companies are going to go public, they need to be professionally managed, institutionalized, well, that kind of mindset, not more like, small companies which are going to be M&As or whatever. And, $1 billion, $2 billion M&A is also possible, not possible. It's not that it won't be possible. Then they are not IPOable company. And we are very clear. Then if that's the case, fine, it's totally okay. It's totally cool with that. But we look at whether they have the ability to create that team or not. Because all said and done, right, at an early stage, I'm betting on the guy and probably the core team that he's created. But is he willing to sort of step back and say that, listen, from 10 to 20 or 10 to 50, I could do it. But from 50 to 500, it needs a different team altogether. And successful cases, right, in family business management, you always see the first generation basically, sows a seed, the second one scales it, and the third one usually takes it down, right? And, the right, family businesses is where the second one successfully transitions it to a professional management to ensure that, that it doesn't matter if my family is sitting back, but the company is going to be professionally managed. Look at, like, I would take an example like Asian Paints, right? They've really managed it at creating a professionally managed company. Or look at Tata Sons. They're a professionally managed company, right? And all Tata companies are professionally managed company. Look at Walmart, for example. Walmart family is sitting in the back, and, there is a professional team that runs it. So we will see, those kind of players also. We will see them. It's up to the investors to sort of say, are they comfortable with that? It should not happen that, hey, I want to go and, invest in this company with the hope that, this will be a 30, 40-year-old company, but ends up being just a, small company where, the promoter doesn't want to do anything. He's not looking at the institution or whatever. Then there's a mismatch over there. But, founder psyche is too hard to assess in the first meeting. Over a period of time is what you assess, and you will do that. But we are seeing both. We are seeing both.
Is But is the rest of your side of the ecosystem, like let's say the rest, other VCs in the pool and everyone else, all this liquidity in the market, do you think that is also sort of influencing founders to think a certain way now? Because it's hard to hold on to conviction, when there's so much money being thrown at you. So
No, it
is
is.
that,
It
do you
is.
see that happening?
Yeah, I do see that happening. I will not say that. And I think, a couple of days back, I said the same thing that, as the funding is peaking, I think ego and arrogance is also peaking across the ecosystem. It is peaking. And it's human nature, in my opinion. Now, not everybody is a stoic in certain sense where they will be able to manage, the greed, lust of, so much of money thrown. And, you have to understand that these are young people, right? Not that I'm not young, I'm also young as well. But, you know, um, you need to really have experienced and, your good coaches and guides around you to sort of say, don't fall for the trap of, this too much of money or whatever. Don't lose focus, right? Stay grounded, because all said and done today, you know hot money flows in fast and it flows out fast as well, right?
Mhm.
And just like a tsunami, it will come fast, and when it recedes, it will leave a debris which is very hard to clear, right? You don't have to be one
Mhm.
of them, right? So yes, there is a kind of psyche where people are getting carried away, but I think you know this industry is where the investors are privately coaching them and saying that, hey, listen, okay, good, you've got to
Yeah.
this particular place. Now focus on execution. Focus on execution. There are times where we have to say that, listen, yeah, I know there is market is hot, you have to go fundraise, but hey, why don't you sit quiet and you just focus on building and executing it. See, if you're really doing well, your product is well, it doesn't matter whatever the market is, money will flow,
Mm.
right? So you don't have to worry about it. Just get those things right. Sometimes, yes, some may want to sort of raise money because there is too much of liquidity available to create war chest. That is also okay as a strategy. You should know why you're raising money for. Just because there is too much of money you're raising, but you want to build a war chest, maybe then that's okay. You want to really, your business needs that kind of capital, then it's okay. Otherwise, it doesn't make sense, because then there's a double-edged sword that is hanging on your head, which is your revenues have to catch up to the valuation, otherwise the valuation will catch up to the revenues, right?
Yes.
So it's more of that. And people always forget that when you raise money, right, you also have to return the money. And when you have to return the
Mm.
money, um, if you don't scale that particular company well, you don't lose you lose a good amount of money, because you sit as a founder on the
Yeah.
lowest stack, which is the equity stack, not on the preference one. So you have to be very careful when it comes to raising. You have to raise very sensibly. Someone jokingly did say, right, it's almost like fundraising is almost like you need to know how much you should drink. If you don't drink
Mm.
responsibly, you'll get a hangover. And same as with capital, right? If you don't raise responsibly, right, there'll be a hangover, right? And it can be
Mm.
bad. So there are times where founders do get carried away, and we tell them that, listen, just focus on fundraise, focus on these things. Another thing is, they do get distracted when their competitors raise a lot of money, and they're
Yeah.
like, oh shit, man, everybody's raising money, I also need to raise money. Now, yes, as I said, there have been cases where competitors have raised money, and then they've gone down or they've done really well, right? But it's a validation that your category is good. If your business is good, your product is good, you don't have to worry too much. Don't let that anxiety peek in, because it's start of you getting rattled out. You don't have to be rattled, right? This is a very, very long term patient journey.
Mhm.
And you have to just take care of yourselves, and these try and avoid all these things that will come and hammer you and distract you. It's a hard job. It's a hard job.
Mm.
But yeah, they're getting distracted everywhere. Investors are also, I won't say to be blamed for. Everybody has to take a blame, right? If founders are raising because they think that this is their time and they should raise more, investors are also giving money to them. So both are to be blamed to certain extent, but not in blame sense. This is the opportunity. If you don't capitalize now, somebody else will, right? So seize this moment. That's what it is.
It kind of leads to an interesting question, right? In some sense, as you mentioned, you all are invested in Zomato when it went out. The amount of just general kind of public uh, speaking about a loss-making company at that point in time going public, right?
Hmm.
And I think that all of us understand why it still makes sense to kind of invest in that. But how do you respond to questions like that, right? Because again, it kind of feeds into what you're discussing here, where there is an overheated investment environment, which leads to additional kind of loss-making companies raising more and more funds at higher and higher valuations, and then eventually everybody does want to, like, I mean, like an IPO is a goal, right? So how do you what is the response to people who are thinking that in that way?
Correct. But before that, I wouldn't say IPO is a goal. IPO is just another milestone,
Fair. Okay.
because, if IPO is a goal, then you're done, the race is over. I don't think the race
You're
is
right. It's a
over.
milestone. I
So
misspoke.
it's just a milestone. Coming to, when these questions come, so one is, we don't respond because, it's very difficult to sort of respond and convince everybody.
Right.
It's out there, people need to self-educate themselves and learn about it. But yeah, sometimes what we try and tell them is you have to look at things with a very different framework, right? You know, the laws or probably, whatever govern for a typical public market company, do they apply here? Probably no, because this company is very different, right? We haven't seen a company like this before. We haven't seen a, high growth company like this before. It needs a little venturish mindset to evaluate and assess this company, right? So you have to, we try and explain that, what is the right framework to think about these opportunities. We educate them on that part, and we try and convince. After then, if they're not convinced, we can't do anything else, because at the end of it, everybody has a view. That's what makes it a market, right? We have a view where we are buying. There is someone who has a negative view who's selling. That's what makes it a market. So after a point in time, we can't do too much, but we try and explain them that this is the framework to look at opportunities. Don't look at it from a conventional opportunity, a conventional mindset.
Right. I think it's, in some ways there's like a slight morality kind of angle to it as well, in the way that they are describing it, right? Or the way that the critics of a IPO like Zomato do describe it. They're, the thinking by morality, what I mean is something along the lines that these are these are slick companies which are coming in and they're trying to take public money and that kind of thing, right? And so I worry about it mostly from that perspective, right? Because again, we have a tendency to make bad laws over here in this country, and so it worries me about it from that sense, right? When you have fairly prominent people coming up with what I consider to be ignorant points of view around these kinds of things.
Correct. So I will just make, with full disclosures, we are investors in them, pre-IPO investors. We are not, very major shareholders. But the way I look at it, a personal comment is, if you look at the IPO very clearly, right, it's an IPO where, they've raised primary money, the offer for sale, where the founder is selling or their existing investors or early investors are selling. Are they taking money off the table? I don't think they're doing that at this point in time, right? It is just that this particular company, which had the stock, which is illiquid, is becoming liquid. A greater share or greater shareholding of that company is still very institutional. Now, institutions can take this risk. Can retail take those risks? No, right? But retailers are allowed to sort of buy and sell if they would want to, for whatever that allocation is there, but still is a very small as compared to the whole thing. And they know the full disclosure. Okay, this is the company, and these are the numbers of the company, and they're making those disclosure. It's not where a big chunk of the company is basically being offloaded to retail or on their head.
Yeah. It's not like a massive that public market held company.
Yeah. So it is not like a good part of the company has retail shareholding as a portion, right? So I think that's where people are being smart about it. That, hey, listen, and right caveats are being put that, okay, transparently, these are the losses of the company, these are the revenues of the company, this is what the shareholding is, this is what it is. We're telling retail investors or whoever is, the brokers are telling, or the sell side people are telling that, these are the things. But the same people, right? The same retail investors are okay to invest in penny stocks. They're okay to invest in something of that sort. But this is a professionally managed company with a high growth and still underpenetrated food delivery market. You won't stop eating food. Right. So now, and you have lived and breathed, like you live, breathe this brand, this brand.
Yeah.
Right.
Yeah. You're buying into the conviction of the rest of the institutional investors.
Yeah, you're buying the conviction of it, but also your experience that, hey, listen, I to order Zomato 3 times a month. Now, even if I order, let's say, like in a month, there are 90 meals that we consume. Okay. 30 breakfast,
Yeah.
30 lunches, 30 dinners. Now, I order 3 to 4 times, let's say. Even if I double it from here and I go order 10, I still am eating at home, right? But is
Yeah.
that, 4 becoming 10? Is it like, no, but it'll create a huge company, right? And at the same time,
Yeah.
that pool or the number of people who are ordering will also increase, right?
Mhm.
So still there is a lot of growth left in the company, right? This
Yeah.
isn't going anywhere. So I know this is something that I'm okay to buy in. So people who are buying in are okay to buy. But with retail investors, I always say that at least know what you're buying into. Like, there was a case where, Nirmala Sitaraman was talking about, something about solar, right? That, and there was a stock which named solar, but
Yeah.
creates explosives, and that stock went up. Now, if you do this kind of thing, right? Then even the regulator will come and say, "Was I can't help it because you're buying something which you don't understand, and I can't stop you."
Yeah. Yeah. People do. I mean, we've seen incidents of that in so many ways where people
Yeah.
have bought random named companies.
So
But
so those things happen, right? Those things happen, but otherwise, I think people are being careful, and people are you know uh, ensuring a clear communication of what you're buying into, and we're telling you very clearly. Till the time that is there and the corporate governance is there, I think these companies are good, and this is where they'll grow. Right?
No, I agree completely. I just worry about because in some sense I also see conflicts with some of these people who are making these comments. Right? They don't like or I don't know. I don't want to ascribe motives. Right? But I feel that these are opportunities which are being made available to people who are not having the same kind of access as some of the people making these kinds of comments. Right? And I mean, like if I want to invest today as a individual in the internet in India, where can I invest? I can't invest.
You can't invest. You can't invest. You can't
Yeah.
invest. So, this is the thing, right? See, do I blame them? No, they have a view. They have a smartphone, they have Twitter, they can do whatever they want. Freedom. Okay.
yeah.
It's totally okay. You know, uh, Eventually people have to take their own call, and based on their own call, they will make money or lose money.
Yeah.
Hmm.
That is bottom line. Okay. If
Correct.
they've heard someone and listened to
Yeah.
someone, and according to that, they're making the call, then there is something wrong in that place itself. So, you can't help it. And again, with all these people, right? See, this is how it happens. Even Warren Buffett was not very, savvy about tech investments. He had not invested in tech.
Yeah.
I think he missed out on tech investment, a good part of it. Does it make him a bad investor? No, he has a view. But investors keep changing their views. There was a company that I didn't like at seed stage, but there's a company, the same company I like it at growth stage.
Right.
Right.
Yeah.
So people keep changing views. I think these people will also, over a period of time, when they get confidence of with the numbers, with the growth, everything, they will change their view. Yes, negative can also happen. Probably the company doesn't perform. Then the views can change. Then even the investors who are there, who were talking good, can probably talk negative. So
Yeah.
I think it'll keep changing. It's something, at this point in time is a very,
It's a good point you mentioned because in we've not had obviously a IPO, a public market IPO like this before, and which everyone can participate in. But what you just shared is also something which is interesting for the startup ecosystem to know going into this. Right now, there'll be a lot more IPOs. I mean, there are a bunch of them slated for later this year. There will be founders who are today taking, let's say, CED, growth stage money, and eventually going to go IPO. Is Zomato, to be honest, has put a good, I would say, set the bar of how to deal with all of these comments, also how to deal with building your brand over the years and hoping for retail to take you in spite of being loss making, in spite of being all the things that they are.
Yeah.
So it's a good story. So in a way, coming back to your personal sort of the view on the market, given that again you guys are a institutional investor, you manage retail assets, you do so many things as a fund, right? As a fund house, you guys obviously are full spectrum in that sense. Like you've entered into all of these stages. You probably have a good ringside view of where each of these the maturity will come from. Going forward, Ashish, what is it that you think you guys are going to do? Like, what is the next strategy you are thinking of as a VC, as an investor in India? how to make sure that do what is good for the ecosystem as well as do what is good for your LPs, and to give them disproportionate returns.
See, one thing that I want to do, and I've just not been able to do in the last 18 months, is for ecosystem. See, on the financial services side, we definitely do have some way in which we can help the investments that we make, right? Make a meaningful introductions, etc. We understand, debt kitna hona chahiye and all that stuff. We understand from where to take debt, who are the right people to engage with, because there are so many parties out there, right? We do not have something on the SaaS front yet. We want to build that function, and we want to do it in a very interesting ways. I think in the last 6 months, I've spoken to several SaaS investors and founders as well. One corridor that I feel where we can add value is by creating a network or some way in which we can help some of these SaaS companies tap into the Southeast Asia plus the Korean market, which again are very high AOV markets. And that will only happen after I start traveling to Seoul. And, because over there, you need to have people on ground who can help us, system integrators, etc. And, once that is there, then, people will see direct value in what we are trying to do. And they may look at us as, okay, these are people who can, because SaaS founders are very clear. They want to clearly see the value. I don't care about your money because I have the same, money available from everywhere. Can you get me sales? So I want to make sure that, I get that particular piece sorted on the SaaS front. That is something that is a personal project that I want to run. Of course, we continue to be very aggressive on India, and we will keep investing into India. And, we will have another fund, which is, I would say focused more on India investments. So we'll continue to wrap up our India investments. We'll continue to beef up our India team to sort of make decisions. I think we've improved our decision-making speed. We just want to make sure that, we continue to live to the speed and, we work as fast as we can, because I think speed has become a very important element now in deal making. It's not just money, but it's about how quick can you decide and how quick can you give the money, because it's good also. Why I say it is because I think founders, the amount of time that they spend on fundraising, if they spend it on business, there is revenue certainty, right? Because I always say revenue is certainty and, funding is probability. Why do you spend more time on, probabilistic events than on certain events, right? Certain events should drive probabilistic thing, which is funding, right? So, which is good, I think, which is we want to sort of focus on and continue to do that. I think these are the few things that we want to focus on. We continue to remain long on India. That's what we want to do. And as I said, companies which are very keen to go list in Indian exchanges or global exchanges, we would love to partner with those kind of companies, because there is a huge play that we have in the public market side. We understand public markets fairly well as compared to a lot of other typical VCs. So I think that's something that we would continue to play that card. That's it. Nothing else apart from that, I think.
That's quite a bit, actually. The SaaS point is obviously very interesting, right? Since you have access to a market which most others probably don't in that as much detail. So very interesting. Ashish, thanks for spending this time talking about so many things while obviously on the back, I'm sure you have like deals lined up and money to be deployed. But in case anyone who listened to this show is interested to talk to you, what's the best place to reach you? I know you're on Twitter. Do you want to shout out your handle or anywhere else people can reach you?
So I'm very much available on my email ID, which is dave.ashish@miraeasset.com. I'm there on Twitter, also on LinkedIn. So, you can reach out to me on any of the mediums.
Super. Awesome. Also, a quick reminder to everybody, please do a review or a rating wherever you're listening to the show. That really does help spread the word. Also, tell a friend if you enjoyed this conversation. Let them know about Ashish's interesting thoughts on all kinds of things.
Yes, absolutely. And I'm hoping that, someday we get some sort of attribution saying, hey, I heard about Ashish talking on the Shunya One and led to my Series A. So, which is great. We'd love to hear that story and have you on as a founder talking to us later, if that ever happens. But Ashish, thank you so much. This was a great chat.
Thank you. Thanks, Shalad.
Learned quite a bit for sure. And of course, we'll continue to keep looking out on all the very, very interesting deals that you all are doing. in the market.
Thanks,
Perfect.
Shunya. Thanks, Amit, for having me. Thanks a lot for having me, guys. Thank you. I enjoyed the
Thanks.
conversation. Thank you.
Thank you.
IVM.